Hello and welcome to AI Market News by LM. Before we begin, please note, this video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Okay, welcome to the deep dive. Today, we're going to sort through a pretty thick stack of market commentary, lots of data points. We're aiming to really cut through the noise.
Yeah, there's a lot going on. We're looking at global currencies, U.S. stocks, sentiment indicators.
The works.
And the goal here is simple. Give you a clear, structured summary of what's driving market sentiment right now. There's this whole AI frenzy, central bank uncertainty. It's a lot. We want you to walk away feeling informed, not overwhelmed.
Exactly. And based on the resources we've looked at, the big picture seems to be this split. You've got, on one hand, this intense, concentrated, extreme greed, mostly in AI and big tech.
Right. But then contrast that with a much broader risk-off feeling elsewhere. Plus, you have central banks in Asia, the US, Australia. They're all sounding pretty cautious. It's like two different markets running at the same time.
A tale of two markets, yeah.
Yeah.
Okay, let's unpack that first part, then the AI dominance.
Yeah.
Because that really is the main story in U.S. equities, isn't it?
Absolutely. It's the headline act.
Yeah.
And the deals we're seeing, they're not just large, they are staggering. It's pouring capital into a very, very small number of names.
Like the Amazon AWS deal.
Precisely. Reportedly $38 billion 7 years for AWS to supply OpenAI with compute power. And guess what chips they're using? Mostly NVIDIA.
Of course.
And then you've got Microsoft putting around $10 billion into an Australian data center company, IRN, again, just for compute capacity. It's an arms race.
It really is. And how are they paying for all this? They can't just be profits, right?
No, and that's a fascinating angle. We're seeing massive corporate bond sales. Alphabet just did $18 billion. Meta recently did $30 billion. And they're explicitly using this money to fund the AI infrastructure build-out.
So what does that mean for, say, the bond market? All this corporate debt flooding in.
Well, it's interesting. Some analysts think this huge demand for high-quality corporate bonds might actually be creating a sort of floor under Treasury yield, especially medium to long-term ones.
A floor. Okay, explain that. Does that mean bond yields won't fall much, even if the Fed, eventually cuts rates?
That's the idea. Basically, if top-tier companies keep issuing tons of debt, that issuance soaks up liquidity. It means even if the Fed signals cuts, there's this constant supply of attractive corporate paper competing with treasuries, which could stop treasury yields from dropping too sharply.
Interesting. Like a structural support for rates driven by tech spending.
Exactly. It's a pretty big shift in dynamics.
But, okay, this AI part is booming.
Yeah.
But you said the rally is narrow. How narrow are we talking?
Critically narrow. Like one source noted, over 300 companies in the S&P 500 actually fell overnight, even while the big tech names pushed the main index up.
300. That's a lot.
It is. And historically, when you rely on just a handful of stocks, the eventual pullback can be pretty rough for everything else. It signals, maybe liquidity isn't as strong under the surface outside of that tech bubble.
And the big Wall Street CEOs are noticing this narrowness too, right?
They are. And they're being surprisingly open about it. We're hearing from heads of Morgan Stanley, Goldman Sachs, basically flagging that valuations look stretched. Ted Pick at Morgan Stanley even said maybe investors should welcome a healthy 10-15% correction.
Welcome a correction. That's blunt.
It is, and the numbers kind of back it up. The S&P 500 is trading around 23 times forward earnings. The average over the last 5 years is more like 20x.
Okay, so elevated.
And the NASDAQ 100, that's way up there at 28x forward earnings. Just 2 years ago, in 2022, it was down at 19x. So yeah, quite a run-up.
That kind of rapid jump, especially concentrated, must make regulators nervous. Like that SK Hynix situation in Korea.
Perfect example. SK Hynix makes crucial memory chips for NVIDIA. Their stock went up, get this, 240% year to date.
240%.
Yeah, including a 70% jump just in Q4. It got so hot, the Korean exchange actually had to issue an investment caution warning. It shows how this global AI excitement can create these almost parabolic moves that worry regulators.
And politically, this is all happening against that backdrop of U.S.-China tech tensions, especially around NVIDIA chips.
Absolutely. It's a constant tightrope. Reports suggest U.S. officials told former President Trump not to approve selling NVIDIA's top-tier Blackwell chips to China because of national security.
Right.
Now, NVIDIA's lobbying, but they're pushing for a scaled-back version, maybe 30–50% less powerful. It just highlights how tough it is for these companies to balance the huge Chinese market with Washington's restrictions.
Okay, so that's the equity picture. AI boom, narrow rally, valuation concerns, geopolitical friction. Let's pivot to currencies. You mentioned central bank caution. The yen seems like ground zero for intervention watch.
Yeah, the yen is definitely where the action is, or at least the threat of action. USD JPY was trading around 153.47 earlier today, Japanese time. A slight strengthening for the yen.
And that was linked to intervention fears.
Directly. Finance Minister Katayama came out with warnings, again, about watching out for rapid one-sided moves. The market reads that as drawing a line in the sand, probably near that 155 level against the dollar.
Okay.
So that renewed vigilance, plus maybe some whispers about the Bank of Japan hiking rates sooner than expected, gave the yen a little boost.
Right, the BOJ. What's the actual thinking there? Are they close to moving, or is it just market chatter?
Well, that's the million-dollar question, isn't it? The signals are really mixed. You have Prime Minister Takaichi saying they're only halfway there on hitting sustainable inflation with wage growth. That sounds like, keep policy easy for now.
Okay, so political pressure for patience.
But then you hear from the banks. Mizuho's CEO, Kihara, suggested the BOJ actually does have room for maybe 1 or 2 rate hikes.
Oh, really?
Possibly December or January, he thought, if they get more confident about wages picking up. So yeah, politics says wait, finance says maybe move soon. Divided signals.
And how are traders positioned in USD JPY? Is it a crowded trade?
Very. Looking at some ONDA data, it shows way more open short positions than long ones, and more sell orders than buy orders.
Meaning most people are betting the dollar falls against the yen.
Exactly. They're betting on intervention or a BOJ hike. But when big banks like Nomura, BofA, Goldman are saying the dollar might actually test 155 soon, well, being heavily short makes you vulnerable.
Quite a short squeeze potential.
Huge potential. If the price rips higher against that crowded short base, you could see a very sharp, painful move up as people are forced to cover.
And this dollar strength isn't just versus the yen, right?
Right.
The euro's feeling it too.
Oh, for sure. The dollar's been strong across the board. It just had its second biggest monthly gain this year. That's kept EUR/USD down, trading around 1.1505.
Why the relentless dollar strength? Just U.S. rates.
Partly U.S. rates, but also relative growth perceptions. The economic data out of Europe has been, let's say, less impressive. So the market sees the U.S. economy as maybe better able to handle higher rates for longer. That favors the dollar.
Okay, got it. Let's broaden again to the macro picture, starting with the Fed. You mentioned data gaps earlier.
Yeah, the Fed's in a bit of a bind. They're getting mixed signals from the economy anyway, but now there's this risk of the government shutdown becoming the longest ever.
Right.
Which means key economic data releases could be delayed or compromised. Making policy decisions without reliable, up-to-date numbers, that's tough. They're kind of flying blind, or at least partially blind.
And you can see that uncertainty, what Fed officials are saying.
Definitely. There's a clear split. You've got Governor Cook, Governor Daley. They seem more focused on the job market, aiming for that soft landing, maybe willing to tolerate a bit more inflation for it.
Okay.
But then Governor Goolsbee sounds, distinctly more worried that inflation is still too sticky and might need more work. No clear consensus there.
But despite the Fed being divided and the data being messy, what are traders actually betting on for the next move?
Well, according to the CME FedWatch tool, traders are still pricing in a pretty high chance, like 70% of a rate cut by December.
70%. Wow, that seems aggressive given what the Fed members are saying.
It does. It suggests traders think the economic uncertainty, maybe amplified by the shutdown risk and data vacuum, might just force the Fed's hand, regardless of their internal debates. It's a bet on circumstances over stated policy intentions.
Okay, how does that compare globally? Are other central banks showing similar division or caution?
We're seeing a lot of caution elsewhere, maybe less division. The Reserve Bank of Australia, the RBA, they just held rates steady.
Why?
Mostly because inflation down there was stronger than they expected, and their housing market seems to be heating up again, so no real reason for them to ease up yet. They're watching demand.
And China. Any moves there?
Yes, actually a significant one. The PBOC, their central bank, bought about 20 billion yuan, maybe 4.3 billion US dollars worth of government bonds in October.
Is that unusual?
It was the first time they'd done that this year. So it's seen as a pretty clear signal they're stepping in to provide more support for the economy, boost liquidity.
Okay, one last piece on the U.S. macro picture, credit risk. I saw something about subprime borrowers.
Yeah, this ties back to that two markets idea, but for households. The percentage of subprime borrowers in consumer credit hit 14.4% in Q3.
How does that compare?
It's the highest since 2019, significantly higher than before the pandemic. It shows rising stress at the lower end of the credit spectrum.
But isn't overall credit quality okay?
Well, that's the bifurcation. At the same time, the share of superprime borrowers, the most creditworthy, is actually increasing. So you've got growing risk at one end and growing strength at the other. The recovery clearly hasn't been even.
A polarizing credit market. That's a worrying sign. Okay, before we wrap this up, let's quickly look ahead. What key data should we watch this week? Let's use the investing.com calendar, U.S. times.
Sure. So for Tuesday, November 4th, keep an eye out for the U.S. trade balance at 8:30 a.m. Eastern.
Okay.
Then at 10:00 a.m. Eastern, we get two important ones, factory orders and the JOLTS job openings report. JOLTS is always a big one for the Fed, watching the labor market.
And anything international?
Yeah, ECB President Lagarde is scheduled to speak Tuesday morning Eastern time as well. Her comments on Europe's outlook will be important, especially for URUSD.
Got it. So pulling all this together, the AI frenzy, the narrow market, the yen watch, the divided Fed, the credit split, what's the main takeaway? What's the overall mood?
I think the mood is tense. You've got this undeniable greed driving the AI narrative, pushing those specific stocks higher. But underneath, the broader market is definitely showing risk-off signs. Valuations are high, the rally's thin, central banks are nervous.
So the warnings about a correction, that 10-15% dip, they feel credible.
They certainly deserve attention. The big tension isn't really if AI keeps growing. It probably will. The question is more about the cost to the rest of the market if we do get that healthy adjustment, especially when the Fed might be making decisions with incomplete data.
Right. How deep could the pain be outside of tech if that adjustment happens while the Fed's navigating by guesswork because of data delays?
Exactly. That uncertainty, combined with the split we see in household finances, it just calls for caution, doesn't it?
It really does. Okay, that was a fantastic deep dive. We covered a ton of ground from multi-billion-dollar tech deals down to specific currency levels and credit scores.
We tried to connect the dots from the regulatory flags in Korea to the pressures on U.S. households.
So a final thought for you, the listener. Considering everything we've discussed, the divided economy, the bifurcating credit market, the geopolitical risks around tech, what does the extreme narrowness of this stock market rally really tell you about how sustainable this whole cycle might be? Something to chew on.
Thanks for joining us for this deep dive today.
We really hope this gave you the shortcut you needed to feel well informed. Thanks for watching. Don't forget to like and subscribe.